Okay, today we are doing one more question from ACCA Study Hub, the new resources. And this is one of the MTQ of EPS earning per share, which is IAS 33. Now, please have a look. The issued share capital of Savoy Company, a public listed company, at 31st March X4 was 10 million, right? $10 million, shares of 25 cents each. Now, this is the share capital and this is the face value. So we all know how to calculate number of shares. Whenever share capital is given, whenever issued ordinary share capital is given and face value is given, we need to divide. So what we'll be doing like this. If you want to calculate number of shares, so this will be 10 million divided by 0.25, which is 40 million. Okay, 40 million shares. So that means at 31st March X4, we have already issued 40 million shares, right? Savoy companies attribute to its ordinary shares for the year ended 31st March X4. This is the profit. Profit is $10 million. Now, the next year, this year end is 31st March X4. So automatically the next year end will be 31st March of X5. So let's see what happens. There is only one issue. On 1st July X4, Savoy Company issued 8 million ordinary shares at full market value. Earnings attributable to ordinary shareholder for the year ended 31st March X5 were 1380. Now, this is the information. Now, the next information relates to next accounting period. So leave it. First, let's do this 31st March X5. There is only one issue, which is full market price issue. I hope you remember the treatment of full market price issue. Okay, so this will be, no wait, this is 31st of March X4 and this is 31st March X5. So here we have 40 million shares in the beginning. 40 million shares. I just gave you the calculation. I just showed you the calculation of number of shares. Now, on 1st of July X4, we issued full market price. I use the word full MP issue of 8 million shares. Full MP issue of 8 million shares. Yes. So, you know what? Full market price issue are never adjusted from the beginning of the year. Never. Full market price issue are not at all adjusted from the beginning of the year. We just take the impact from the date. We just take the impact of full market price issue from the date when they are issued. Yes. And we used to calculate weighted average number of shares. Hope you remember, because these are not free shares. These are not free shares. So we used to calculate weighted average number of shares. Now, can you see this? After 31st March X4 means in reality it's 1st April. So April, May, and June, these 3 months, your total number of shares, outstanding share will be 40 million. And from this July, August, September, October, November, December, Jan, Feb, and March. Okay, the last 9 months, the total number of shares attributable are 48 million. So if you want to calculate the weighted average number of shares, see, this is the requirement of 1. So we will write like this: 40 multiplied by 3 upon 12, because in the first 3 months only 40 million shares were outstanding, plus 48 million multiplied by 9 upon 12. Now let's check it out. See, what is the number of shares to be used in the basic earning per share? In the basic earning per share for the year ended 31st of March X5. For the year ended 31st of March X5. Okay. So let's do it. 40 into 3 upon 12. This is 10. Plus 48 into 9 upon 12 is 36. So this makes 46 million. So this is the answer. A is the answer. 46 million is the answer. Right? Now there is one MCQ is missing in this. I think my typist has miscopied, or there is some error in the ACCA Study Hub screen or something. That's why. So now number 2, second MCQ is missing, but I will still read the right issue. I'll still read the right issue. See this. In this year, see this year ended 31st on 1st October X5, Savoy company made a right issue of 2 shares for 2 new shares, 2 for 5. See, 2 for 5 right issue. It's 2 for 5, 2 new shares for every 5. Now, at our issue price is $1. Issue price is $1, whereas the average market price now, the market price of Savoy companies immediately before the offer was 2.4. So average market price was 2.4. Now, hope you remember my lectures. Hope you remember the lectures. See, hope you remember I used to say this dialogue a lot. In every right issue, there are 2 issues. In every right issue, there is a bonus issue. There is a hidden bonus issue. There is a hidden bonus issue. Why we are saying there is a hidden bonus issue? Why? Because the market price is 2.4. Market price of these shares are 2.4, but we are giving for $1 only. We are giving for $1 only, $1 only. So there is a discount. There is a discount in it, or there is a gift in it. So we can say in every right issue there is a bonus issue as well as a full market price issue. Now I'm just telling you orally the treatment, because the MCQ relating to this requirement is missing. Listen, now what will you do? You will take the impact of bonus element right from the beginning of the year. You will take the impact of the bonus element right from the beginning of the year through BAF, bonus adjustment factor. And what is the formula for bonus adjustment factor? Let me recall you. Market price per share just before right issue divided by theoretical X right price per share, divided by theoretical X right price per share, right? Okay. And then you have to calculate weighted average number of shares and so on. Okay. Now the next thing. Now the next thing is, this is now all about convertible loan notes. It's all about convertible loan note. What amount are earning? What amount of earning should be used in the diluted earning per share calculation for the year ended 31st March X7 now? You hope you remember in the diluted EPS means reality plus imagination. Reality plus imagination, right? Okay. So let's see. And for diluted EPS, we need to see potential ordinary shares. For diluted EPS, we need to see potential ordinary shares. On 1st of April X6, Savoy company issued 20 million 6% convertible loan note at par. Okay. On issue, Savoy company recognized 19 million. So this is the relevant 19 million as the liability component. Hope you remember by now that in convertible loan notes, there are 2 elements. One is equity and one is liability. But whatever goes in the income statement, listen very carefully. Whatever goes in the income statement expense is this liability element multiplied by this market rate. Liability element multiplied by the market rate, because now you have done IFRS 9. I repeat, normally students do EPS right. When I teach as a first chapter. I teach EPS as a first chapter before IFRS 9. So in that case, you guys don't know between liability and equity element, but now it's the end of the course. These are revision days. So now you know complete thing. So if you know complete thing, so whatever thing goes in the P&L, whatever amount goes in the P&L for the convertible loan note is liability element multiplied by the market rate, which is 8%. Remember the discount rate. Let me call this in Urdu Hindi language. लाइबिलिटी एलिमेंट को हम मल्टीप्लाई करते थे, याद है, डिस्काउंटिंग करके लाइबिलिटी एलिमेंट निकालते थे और फिर लाइबिलिटी एलिमेंट को उसी रेट से मल्टीप्लाई करते थे जिस रेट पे अनवाइंडिंग हुई थी, और उसी रेट पे हम जिस रेट पे डिस्काउंटिंग हुई थी उसी रेट पे अनवाइंडिंग करते थे, दैट इज मार्केट रेट. ओके, राइट. So the rate which is used for discounting, the same rate is used for unwinding. So 19 million multiplied by 8% will hit your PNL. 19 million multiplied by 8% will hit your PNL. Be careful. The market rate for similar loan notes having no conversion rights. The terms of conversion are that with every $100 loan note will be convertible into 50 ordinary shares, be issued at the option of loan notes holders. Alternatively, the loan notes will be redeemed at par for cash. Okay, the income tax rate is 25%. Earnings, these are the real earnings. Earnings attributable to ordinary shareholder for the year ended 31st. See, these are the real earnings. Okay, so now just giving you a recap of diluted EPS. What we do in diluted EPS, we just close our eyes. We just close our eyes and listen, we just close our eyes and we just think that whatever conversion is going to be happen in future, like 3-4 years forward, if that conversion would have taken place at the beginning of the year, what will happen? So two things will happen. Number one, loan notes will be converted into ordinary shares, so we'll have new ordinary shares. We will have new ordinary shares. Number one. Number two thing is when you convert loan note into shares, your interest will be saved. When you convert loan into shares, your interest expense will be saved. And when your interest expense will be saved, your profit will go up. But yes, you have to pay the tax. So the tax department takes 25%. So you will only get the benefit of 75%, which we call it incremental after tax saving. Okay. So now read the requirement. What amount of earnings should be used? What amount of earnings? See, they are just asking the numerator. They are just asking, my dear student, the numerator. Okay. So I told you this is the real profits. Real profit is 25.2 million plus. How much is the liability element? Liability element is 19 million multiplied by 8%. So this 19 million multiplied by 8% will give you the amount of interest saved. Multiply by 75% because 25% tax will be eaten up by tax department. 25% will be taken by government tax department. So we'll only get this much benefit. Okay. So can anybody tell me what is the final profit? Wait, let me use the calculator. 19 times 0.08 times 0.75. This is 1.14 plus 25.2. This makes 26.34. This is C. 26.34. Please check it out. 26.34. This is the numerator for diluted EPS. Okay. This is just the numerator. I didn't work on the denominator. Even they didn't ask. So why should I do? Now, very common sense question. If a bonus issue took place during the year, what number of shares should be used in the basic earning per share calculation? Now, hold. Don't give your judgment. Just giving you, this is general question. Let us say you have at the beginning of the year, number of shares are 10,000. And then you did in the middle of the year, you did on 1st July, you did 1 for 10 bonus issue. 1 for 10 means 10%. 1 for 10 means 10%. Listen, so 10,000 times 10%, the new bonus shares will be 1,000. So can you tell me 10,000 plus 1,000, the closing number is 11,000. At the year end, the real shares are 11,000. 10,000 plus 1,000 because you have issued new bonus shares, so they are part of your shares, so the closing number is 11,000. Now hope you remember the lectures. In bonus issue, Bonus shares are always adjusted from the beginning of the year. Bonus shares are always adjusted from the beginning of the year. So this is 10,000 plus 1. So that means in the EPS fraction, you will be using 11,000 shares. In the EPS fraction, you will be using 11,000 shares in the denominator. You will be using 11,000 shares in the denominator. You will be using 11,000 shares in the denominator. Be careful. So can you see these 11,000 shares is the closing number? So definitely you are using this closing number in the denominator. Means all shares will be adjusted. All shares, whatever bonus issue you did must be adjusted from the beginning of the year. And if you add these two, 10,000 plus 1,000, so automatically the number which is coming is the closing shares. Okay. You already know this thing because you have taken classes. Which two of the following must be disclosed in the notes to the financial statement in accordance with IAS 33 earning per share? Now we need to show the disclosure. Listen. Interest saved on non-convertible. No. On convertible loan notes, when we close our eyes and we say that whatever conversion is going to take place in future, if we convert it now, if we convert loan into shares, then we get the interest saving. For non-convertible loan notes, it is written openly non-convertible loan. So what is the interest saving? There is no interest saving at all. So what is the need of disclosure? There is no interest saving at all. Now B, number of preference shares currently in issue. No, there is no such requirement now. You have to cross 2 and we have to take 2. Instruments that could be potentially dilute. Yes, for diluted EPS, we need to show the shareholders these are contracts, are potential contracts. These 3, 4 or 2 contracts are potential contract you need to disclose. And D, this is related to IAS 10. Hope you have done IAS 10. Ordinary shares issued after the reporting date. New shares or new loan notes, whatever new shares, listen my words, whatever new shares, whatever new loan notes, whatever mergers you have done after the year end are non-adjusting event. And for non-adjusting event, we need to do disclosure. This is very famous. Point number D is very, very famous. So C and D disclosure is needed. Okay. So now the next question is about IFRS 15. Next question is about IFRS 15. Bargi company is in the process of preparing its financial statement for the year ended 31st December. For the year ended 31st December X6. There are 3 transactions which have not yet been accounted for. Number 1, this has happened on 1st October X6. Keep this date in mind. This is important. A sale was made for a large piece of technical equipment, which included a 3-year service plan. Yes, this type of question comes in final account a lot. That you are giving a generator, you are not only you are giving the generator, but also you are giving 3-year service, 3 years after sales service. So for the equipment, listen to me, for the equipment, as the control of the equipment is transferred immediately, as the control of the equipment is transferred immediately. So you will be booking revenue of equipment immediately, but for service, definitely it's over time. It should be spread over the months. Total sale price was 1.8 million, which was paid on 1st October X6. And the technical equipment was delivered on that date. Yes, you delivered the equipment. On its own, the technical equipment would normally be sold for 1750. These are standalone price. See, standalone price. Hope you read this IS. Hope you have you remember standalone prices. There is a case of discount. And a 3-year service plan would normally 1650. So wait, if somebody buys separately, these two, so 1750 plus 165, 1750 plus 165, it will cost you around 1915. If you add these two numbers, it will cost you around 1915. But as a combined deal, you got it for 1.8 million means 1800. 1.8 million means 1800. So if you buy it separately, it will cost you more. If you buy it separately, it will cost you more. So there is a discount deal. So first of all, we need to apply stage 4. And stage 4, listen to me. In stage 4, you have total price. Look at me very carefully. In stage 4, you have a total price and you have a standalone price of 2 performance obligation. You have the total price of the deal and you have standalone price of 2 separate performance obligation. Now, first you need to apportion the total price between these two performance obligations on the basis of standalone prices, which I will tell you, right? And the next stage is stage 5. Once you have done the apportionment, now the next stage is book revenue. So how to book revenue? Can anybody tell me how to book revenue? Yes, for equipment, the revenue will be booked immediately. But for services is for 36 months. And we have started giving services on 1st October and our year end. See the screen. Our year end is 31st December. Very important point. You can miss this in exam. So from 1st October X6 to 31st December, only 3 months. Only 3 months service we have provided. So yes, we can book revenue of these services for only 3 months out of 36 months, because 3 years means 36 months. 3 years means 36 months. Please listen to me. 3 years means 36 months. So out of 36 months, only 3 months services are given. So that means remaining 33 months are technically your liability, contract liability, or you called it deferred income. Now, no need to read the next paragraph. Just work out on this first paragraph. On this first paragraph. Let me show you the working now. Wait. See this. In my class, I used to teach like this. It's 1.8 million, or you call it 1800 for the total price. And in return, you have given two things. The first thing you have given is equipment. And the standalone price was 1750, 1.75. And for 3 years service, the standalone price is, I think, 165. Okay. 1750 plus 165. So what you will be doing, you will be adding these two standalone price. So 1750 plus 165. Okay, so this is going to be 100%. Now let's calculate the percentages. 1750 divided by 1915 into 100. 1750 divided by 1915 into 100. This is going to be 91.38%, 383%. Okay, and this is going to be 8.616%. Okay, so now we have taken the percentages. Now out of this 1800, just multiply 1800 by 8.616%. So you will get the complete 3-year revenue of these services. So into 1800. This will be 155, 155. Okay. So 155 is the 3-year service revenue. 155 is the 3-year service revenue. And for this, it's going to be 1645. Okay. So if examiner asks you how much revenue you will book for equipment, all these things you have done in your life before. If examiner asks you how much revenue for equipment, the answer is 1645, but this is not the question in the exam. And if examiner asks you how much is the total revenue, how much is the total revenue for 3-year service, this is 155. 155 because this was the discount deal. See, if you buy separately, this it's 1750 and this is 165. But if you add these two, it becomes 1915. But when you pay together, the only payment you did is 1800. That means 1915 minus 1800. 115 is the discount. 115 is the discount. So I did apportionment. Okay. So finally, I calculated 155 as the 3-year service revenue. Now the next step is state 5. Listen. Now your year end is 31st December X6. And you started this contract on 1st of October X6. So October, November, and December, you just gave how many months service? In this accounting period, you just gave 3 months service. 3 months. Okay. So now this is your 155 is the total amount for these services. So 155 into 3 divided by 36. Just think, 155 is the revenue for 36 months. 155 is the revenue for 36 months. So if you divide it by 36, you will get 1 month revenue. Multiply by 3 will give you 3 months revenue. It's going to be 12.9. 12.9, sorry. 12.9 is the revenue. So 155 minus 12.9. 12.9 is the revenue for services for 3 months and minus 155. So 142. 142 is your deferred income at the year end. Deferred income, or sometimes we call it contract liability. Contract liability at the year end. 142 is the contract liability at the year end for these services. And this is basically 33 months. This is basically 33 months. You can have a look at the screen and think over it. This is a very important area. IFRS 15, normally students do mistake in this. Okay. So now read the requirement. Yes, this is point number 3. In relation to the sale made on 1st October X6, what is the amount that will be reported as a contract liability for the service plan? Remember the service plan, it will be how much? 142. It will be 142, 142. The answer is 142,000, but we can write it as 142 because to the nearest thousand, 142 is the answer. 142 is the answer. Okay, I have explained you already. Now next thing. Which two of the following criteria, this is general requirement. Which two of the following criteria are required before an entity should account for a contract in accordance with IFRS 15? This is related to stage 1. Stage 1. And what is the name of stage 1? Stage 1 is means identification of contract. Identification of contract. And hope you remember the class. In stage 1, I always say that the contract must be strong. The contract must be understood by both parties. The contract must be understood. There should not be vague contract. It should be enforceable. It should be enforceable. It should be understood by both parties. Remember, the terms and conditions should not be vague. And one more thing, there should be some commercial substance. It should not be a charity like we are earning something. Okay, all parties to the contract have approved the contract. Yes, this is the point. Approved means it should be understood and it should be agreed by both the parties. That's why the contract is enforceable, otherwise it's not enforceable. The contract must be in writing. No, it may be oral. Those of you who have studied law paper, so you guys know there are some countries in which implied contracts are also enforceable. Implied oral contracts are also enforceable. So there is no need, though there is no requirement of IFRS 15 that it must be in writing. Now see, the contract must have commercial. Yes, commercial substance is very important. It is possible. No, in the IAS it is written probable. It is probable that the consideration will be collected from the customer. This wording is wrong. Probable. It is written probable. You go and read the book. You can read the book. And in the book it is written probable chances of economic benefit. Probable chances of economic benefit. Now the next thing is, again, this is related to stage 4. IFRS 15 revenue from contracts with customers requires the transaction price to be allocated to performance obligation in the contract. Yes, this whole transaction price must be allocated to different performance obligation. And yes, you know the wordings, on the basis of stand-alone prices. On the basis of stand-alone prices at the date of transaction. Stand-alone prices at the date of transaction. Let's pick it up. Where each of the performance obligation is satisfied at point in time. How should the allocation of the transaction price be made? The transaction price should be spread equally. No, never equal. It all depends upon the weightage of standalone price. The transaction price should be allocated relative to the standalone, yes, selling price of the component parts at the date of contract at inception. Yes, at the date of transaction. Yes, this is the answer. Still, we can read C. An agreed percentage of the transaction price should be allocated to the stand-alone selling price of any goods sold, with the balance spread. No, balance spread equally over the term of the contract. No such thing. The transaction price should be allocated based on the never cost. It's a standalone price. So if you read, B is the appropriate answer. B is the appropriate answer. And you guys know this thing, that many times I have said this, many times in class I have said this, whenever there is a theory question, go for most appropriate answer. Whenever there is a theory question, go for most appropriate answer. Okay, now let's read the second contract. Now let's read the second contract. This 18th November thing. This machinery machinery sold by Bargi company in January X6 was found to be faulty and various part was replaced by Bargi company under the warranty. Bargi company normally sells the replacement parts for 80,000. The total cost of Bargi company for the was 60. Now wait, this is very simple case. See, I have given you this pen. I sold you this pen. Okay. Now, and I also gave you warranty that if there is if defects come within 12 months, you can return it. You can return it and I'll give you another piece. So now let us say if you come within 12 months and I replace it, so now my loss will be my cost. For example, the cost of this pen is $60, but I sell it for $80. The cost of this pen, please think carefully. Please think carefully. Concentrate. The cost of this pen is $60, but I sell it for 80. But now whenever you come back to me and you will replace it, so just I'm giving you from my pocket this pen, I'm replacing you this pen free of cost. So I'm going to bear a loss of 60 because the real cost is 60 for me. The real cost is 60 for me. And now I'm doing this replacement for free. Replacement is done for free. So this second transaction is not my revenue at all. This second transaction, the replacement transaction, is not at all my revenue. It's my loss. It's my expense. It's my loss. It's my expense at this cost, right? I say this in Hindi. मैं 80 रुपीज की बेचता था और 60 की खरीदता था, ठीक है, बेच दी। अब जब नेक्स्ट टाइम वो रिप्लेस करने आएगा तो मैं अपने ड्रॉ में से निकाल के उसको फ्री में दूंगा, तो बस जितनी मेरी कॉस्ट मुझे घर में पड़ी है वही मेरा लॉस हुआ ना, मैंने फ्री में किसी को दे दी तो मुझे तो घर में 60 की पड़ी है ना, जस्ट थिंक। एंड देयर इज नो रेवेन्यू अटैच्ड टू इट। replace in the replacement transaction we are doing free of cost. Okay, so now what will be the entry they are asking? The entry for this replacement is this. Listen, first of all I'll put my hand in my drawer and I'll give you a free pen. Like that means my inventory will be out. So I'll credit my inventory. I'll credit my inventories, assuming there is, I'll credit my inventory by 60. See, there is no provision, nothing is written about the provision, no provision we have booked before. And then we'll debit our expense or cost of sales. Expense or cost of sales. So this is a entry, cost of sales debit and inventory credits. Just think, we are giving away our inventory. We are giving away our inventory for replacement purpose free of cost. So inventory is your asset, it will be credited. And in return, it's your expense or cost of sales. So cost of sales debit and inventory credit. You need to book the cost. Again, giving you 1 minute to read this middle part. Read this middle part. So please check it out. Number 4, which of the following statement is correct in relation to the warranty work undertaken on 18th November? A revenue should include, no, this is not a revenue transaction. You are giving it for free. You are doing replacement for free. Not at all any income. Revenue should include 80,000. Wrong. Cost of sale will include, yes, 60,000 for the cost of goods used, assuming no provision has previously been made. Yes, cost of sales will include, means you will debit the cost of sales or you will increase. Both things are same. If you increase your cost of sales or you debit the cost of sale, both words are same, my dear students. Now read the C. Revenue should be included. No, there is no revenue. Why you are saying about there is no earning at all in this transaction? It's a loss transaction. You are giving claims. Cost of sale will, no, cost of sale will be increased. Cost of sale will be increased. It's a bad event. It's not a good event. Now the next thing, last thing, see this thing. This is sale and buyback contract. This contract is sale and buyback. Remember in the class we have done this, that there are some transactions which looks like a sale, but in reality they are loan. In substance over form concept, substance over form concept, legality versus reality, legality versus reality. Okay. Now Bargi, see the date, 1st December X6, just 1 month before the year end. Give message to your mind. 1 month before the year end. Your year end is 31st December X6. Year end is 31st December X6. This happened 1 month before the year end. Bargi company entered into a contract for the sale of goods, for 200,000. That means we sold it. Apparently, we sold it. Bargi received 200,000 on 1st December X6. Bargi company has the right to repurchase, right to repurchase these goods on 1st April X7 after 4 months. See, 1st December X6, then 1 month, 1st January X7, then 1st Feb X7, 1st March X7, and then 1st April, 4 months. See, there is a 4 month gap in between these two dates. See, 1st December X6 and 1st April X7, exactly 4 months gap. And we are going to buy it on a fixed price. Just think, we are not going to buy it at market value. We are going to buy it at fixed price. So what does it means? Today we have taken loan of 200,000. Today we have taken in reality loan of 200,000, and after 4 months we'll repay 240,000. So 40,000 is the interest. 40,000 is the interest of these 4 months. This is the reality of the transaction. Check it out. Now let me make the sketch for you. Listen, this is December month. This is the year end, then January, Feb, and March. Okay. And then you have 1st April. So what you took loan. You took loan of 200,000 here. So first of all, you'll make the entry. Cash debit 200,000 and liability credit 200,000. Okay. Because this is not a sale. In reality, this is not a sale. This is a loan. So cash debit and loan credit. Cash debit and loan credit. This is the first entry. Now, you bought it for 200,000. Please, just 1 minute efforts. You bought it for 200,000. You took loan. Sorry, you took loan of 200,000, and you will be repaying 240,000 here. You will be repaying 240,000 after 4 months. Again, I repeat, we have just taken loan on 1st December of 200,000, and after 4 months we will be repaying 240,000. So exactly 40,000. Exactly 40,000 is the interest for 4 months. Exactly 40,000 is the interest for 4 months. So we are at the year end. See, we are at the year end. So in 1 month the interest is 10,000. In 1 month the interest is 10,000, and yes, this interest will be accrued interest. So the entry will be interest expense debit 10,000, and accrued interest, or you call it liability, accrued interest credit 10,000 liability. Okay. So the two entries which you need to make, the first is cash debit and liability credit. Cash debit and liability credit of 200,000 on 1st December X6. Please focus. On 1st December X6, the entry is cash debit 200,000 and liability credit 200,000. And in this 1 month, as the interest for 4 months, my dear student, is 40,000. 4 months interest is 40,000. So for 1 month, the interest is 10,000. So you will be making entry interest expense debit 10,000 and accrued interest or liability credit 10,000. Okay. So definitely you are not using this revenue at all. See, match the relevant amount to show in Bargi company should account for. So we'll have we'll have a cash of 200,000. See, cash of 200,000. Our liability will be, total liability at the year end will be 210, and our interest expense will be 10,000 by the year end. See, our total liability 200. Accrued interest is also your liability. Accrued interest is also your liability, my dear students. So your and yes, revenue will be zero. Better, you can say revenue will be zero. Your revenue will be zero. No revenue. This is not sale. This transaction is not sale at all. This transaction is not sale at all. So you can also like say like this, that revenue is zero. No revenue is booked for this transaction. Cash is 200,000. Liability is 210,000. And interest expense till 31st December. I again repeat, interest expense till 31st December is 10,000. I've made the entry. You can see the reality of the transaction. Okay, so that's it for today's class. Hope you all are working hard, and please send me your scripts for marking for ratio analysis. Okay, last days are very, very important. Take care and bye bye.